This is our CFMR seminar, and we are very happy to have Bin Zhu from University of Connecticut. And he will talk about hedging with Bitcoin futures, the effect of liquidation, loss aversion, and aggressive trading. So Bin, the screen is yours.
Thank you, JP, for the kind introduction, and thank Mike for giving me the opportunity to share with you the joint work on Bitcoin futures with Carol Alexander from the University of Sussex and Jun Dan from the University of International Business and Economics, which is located in Beijing, China. So this is a recorded talk, so I'm not talking too much of this. Maybe after I can share with you some a partially true story. I mean, it is true story, and I call it partially because this is not obviously not inspired by that particular story. There are many things that inspire our research. So I learned this from people in finance. So we start with a summary, just in case we run out of time, or this is relatively long talk, you lose your attention, right? So let's begin with the summary. What we have done. So I will give you a brief introduction to Bitcoin futures. We all know futures, but I would say even I don't know everything about the Bitcoin futures. In fact, I only know very few about Bitcoin futures. So I will give you a brief introduction. I believe that is accessible to everybody. At the end of the talk, I can guarantee you will know more than most of the people on Bitcoin futures. So that's the benefit, right, at least of attending this talk. Then I will give you the motivations. So why do we think margin and liquidation are important in the study of hedging, in particular with Bitcoin futures? And then is the mathematical part, which is actually simple. It's not complicated. Finally, I will give you some findings from the empirical side. Here I can already tell you, Bitcoin futures, they are effective hedging tools to the spot. In particular, I should mention Bitcoin futures are traded on regulated, unregulated exchanges. We do have very limited futures traded on CME and Barcode. Those are regulated. Okay, their hedging effectiveness is okay, according to another paper I did with Jun. The more important part in this talk is about the risk analysis. We really show that by following this strange optimal strategy, which is constraint, the hedges can really reduce the liquidation probability. So here sometimes I mix the word with default and the liquidation because I consider liquidation a kind of default. It's not exactly default. Okay, so it's better to say this is liquidation probability and implied leverage. Okay, here is a quick summary. So now let's begin with the first part. Okay, something I already promised to give you an introduction on Bitcoin futures. So this I assume everybody knows, right? So this is what I copied from John Howe's famous book, right? Options, futures, and other derivatives, right? That's usually the standard textbook to this area. In particular, I want to mention three things. So when you talk about a futures contract, there is an underlying asset, right? And for the underlying asset, there's a price, right? Meaning there is a denomination currency. So, for us, it's usually US dollars, right? When you talk about, let's say, this is a gold futures. So gold is the asset, right? And you see the price, which is, say, let's say $1,500 per ounce, right? Dollars. So you implicitly choose a denomination currency. Sometimes they call it fiat currency, right? It always comes with expiration date, right? So let's say it expires in 1 month, right? Here are the standard three ingredients in futures contracts. That is not true when we talk about Bitcoin futures. Everything changes. So in fact, even the name, right? When I say gold futures, you immediately know I'm talking about gold as the underlying, right? However, when I talk about Bitcoin futures, Bitcoin may not be the underlying. yes, they are futures, with Bitcoin as the underlying, so sometimes we call those standard ones. But is Bitcoin a currency, which is a debate. I'm not going to argue whether against or for this, but they are Bitcoin futures which use Bitcoin as currency. So meaning the settlement is Bitcoin. So then what is the underlying? Right? Underlying is actually the fiat currency. Okay, so I already mentioned two possibilities, right? So sometimes Bitcoin can be the underlying. Then USD would be the settlement currency or the denomination currency. But you can also switch the position. Okay, this is somehow similar to FX futures, right? You really treat Bitcoin as a kind of currency, and it can be the underlying, it can be the settlement, depending on how you choose it. And later on, people even add the third component, USDT, Tether, right? What we usually call the stable coins. You don't have to limit to USDT, but that's the most popular choice because Tether is the most traded stable coin, right? So meaning you can change USD, right? You want to use Bitcoin as the underlying. Your denomination or your settlement currency does not have to be US dollars. It can be USDT, it can be Tether, or it can be other coins. If you really like Dogecoin, you can create a contract with Dogecoin as your currency, as the settlement currency. So that being said, even we look at this alone, there are so many combinations, right? They are standard, they are non-standard ones. And this is truly innovative. I believe we have never seen a contract that is perpetual. And in the world of Bitcoin futures, there are many, many perpetual contracts, meaning they never expire. If you really want to hold it, you can hold it forever. You can pass it to your child can pass to their child, and so on. So it's maybe the very first perpetual contract, at least to me. I have always been teaching financial math here at UConn, and one of the things I teach is perpetual annuities or perpetuities. Students always ask me, do they exist? I say no. Then why do we study? Because it's important, in some sense, right? Here we actually have a perpetual contract. I already briefly mentioned that most contracts are not regulated. So only 2 exchanges are regulated. Okay, used to be 3. CBOE used to have Bitcoin futures, but they discontinued pretty much 1 year after its introduction. So it lived only for 1 year. The reason is simple. Very few people trade it. The same. Very, very few people trade CME or at Barcard. Most choose unregulated. Okay. And there are many differences. One is trading hours. For unregulated, it never stops. It operates 24/7. So even you sleep, your position don't. So it's always active. Okay. And another thing I want to mention, I didn't put it here, is leverage. So leverage decides your initial margin rate. So let's say, if your leverage is 10 times, which means your initial margin rate, the minimum is 1/8. So it's 10%. Okay. CME has about 40%. Of course, depending on your positions or on your company's particular type, right? Usually it's about 40%. That is really, really high because the first contract CME introduced has a notional value of 5 BTC. So one contract is linked to 5 Bitcoins. So 5 times 40% times the Bitcoin price is crazy, right? I mean, right now, I don't know the Bitcoin price today. It's probably $64,000 per coin, right? So you can do the simple math. It's crazy. I can't trade it. JP might be able to trade it, but I can, right? So why those unregulated are so popular, right? They can go as high as the highest leverage, the 125 times leverage, right? You divide by 1, So that is the percentage you need to open a position. It is crazy, right? I mean, you will never see anything as highly leveraged as Bitcoin derivatives. I mean, it's simply outrageous. Meaning, in most cases, it's 100%, 100 times. 125 is only for very few exchanges. So let's use 100 times, okay? Which means you only need 1% to play this game. Okay, I can play a game as big as 1 million. You just need 1%. Right? And anyone can easily enter this market and play it because it's so high leverage. Okay. I already briefly mentioned this part, right? That's the introduction to Bitcoin futures. Usually, people call it in a different way. So in this talk, I call it standard. Standard means those traded on CME and the barcode. Okay, I call it standard because they are very close to the future contracts we know of from finance. Okay, for instance, those are standardized. Bitcoin is the underlying, except that everything else is just the same as what you already know, right? Recently, CME introduced this, what they call the micro contracts, because 5 is too big, right? Given the price of the Bitcoin. So they introduced this, much smaller contract to help attract more people to trade. The second one is what I call the USDT direct futures. They are very, very close to the standard contracts. The only difference is you don't use US dollars to settle, to do the margin. You use USDT. So now everything is under USDT. So if you want to open an account, you need to deposit your margin, right? And your margin will be in stable coin USDT instead of US dollars. And when you close your position, your P&L will be settled in USDT. So that's it. Okay. The last one, another innovative product in the Bitcoin world, is what I call the USD inverse futures. I have slide to tell you why I call it inverse. Okay. So this is the opposite side of standard. Okay, so now USD or US dollars is the underlying asset. Bitcoin is the currency. So you will margin and settle in Bitcoin. Okay, so some of them have $100 as the notional value. Some of them have $1. That doesn't really matter. So here are the trading volumes. I didn't include the standard because I can't even include in the graph. If you do the same scale, you can't see it. That's why in the research we only consider USD inverse and USDT direct. We consider perpetual because this is a hedging paper. Okay, a huge benefit of using perpetual is that you don't need to roll your contracts. Right, in the standard hedging, a tough topic is how are you going to roll your contracts. Right, so if you use fixed expiry contracts, first you have many choices. Right, at one time there are many contracts that are actively traded. Right, usually we pick the one that has the highest volume. Right, and then we roll to the next one. When are you going to roll? Right, so sometimes the standard is 1 week before the expiry. You roll to the next one. Okay, before you get any trouble of closing it. Right, but it's just a hassle to do it. So we consider perpetuals. Another important reason is, when you look at this graph, perpetuals are really, really popular, right? Those are in billion USD. It's huge. For the USDT direct, Binance is pretty much everything, right? It's bigger than everybody else combined. For the USD inverse, the red one is Bybit. Bybit is catching up. It used to be BitMEX. BitMEX was the #1, but it seems now Bybit is catching up. But anyway, a quick message is that both are popular. Both USD inverse and USDT direct are popular. Actually, in the first version of this paper, we only considered inverse. Okay, and then we realized that we can't just ignore USDT direct because they are so popular. Okay, nowadays. Oh, here I have a graph with CME. Let me show what is CME. This is CME. The truth is, you wouldn't be able to see it in this bar chart. If I zoom in a lot, this is $1 trillion US, and this is monthly trading volume. I mean, nowadays we are somehow used to trillion, right? Because we hear trillion so much, in the news. It's a huge number, right? And this is monthly trading volume. Bitcoin monthly trading volume is at almost 2 trillion US dollars. That is how big this market is already, right? It actually continues to grow. So it may be even bigger. So a quick message is we will consider many of those names because they are the big guys. So here, let me mention what is inverse, okay? So even for inverse futures, Bitcoin is or BTC is the denomination currency, but they are still quoted in USD, meaning after the quotation, you need to do some mathematical work, okay? So the notional size is USD. So both are in USD, but the denomination is actually in BTC. So what you do is, well, you simply divide by it. So I call this the nominal value of the contract. But this nominal value is in BTC because USD will cancel USD. What you have is a number, right? How many Bitcoins you have, okay? It's a tiny number. So the payoff of inverse is very different from the standard. So let me first tell you what is the standard, right? Standard, everybody knows, right? So let's say you enter a long position at time little t and close it at t plus delta t. This is your payoff, right? Or this is your P&L, which is in US dollars, okay? But for inverse, you do the same thing. You enter at little t, you close at t plus delta t. This is the payoff. Right? If you look at my words, it's enter minus exit. If you look at the standard, it is exit minus enter. Right? This is the exit price minus the enter price. Okay, but for inverse, it's exactly the opposite. You use your enter price minus your exit price. Okay, the reason it's simple, because our common sense is that if you long futures and if the price goes up, you should make a profit, right? As you can tell from here, if F at T plus delta T is bigger than FT, you make a profit, right? So in order to make that happen, you have to switch the position. So under this new or this innovative design, your common sense still holds. So if you long and the Bitcoin price goes up, you make money. So that's why they switch the position, okay? And for this reason, I call it inverse, okay? Here's an example, but I don't want to talk about it. The only thing I want to mention is it brings another uncertainty. That is, for inverse futures, your margin account is also deposited in Bitcoin, right? So let's say you want to open a position on inverse futures and you don't have Bitcoin. You have to buy Bitcoin first. So you have to keep Bitcoin in your margin account. So when the price of Bitcoin changes, you may benefit from it. So that's my point of this example. The next example is more important because it tells you what I call the asymmetry effect. For standard futures, obviously, it's just a linear, right? Everything's linear. If the price goes up 20%, you win 20%. If it goes down by 20%, you lose 20%. That is not the case for inverse futures. So when price goes up by 20%, you make less than 20%. But when the price goes down by 20%, you lose 25%. So those are very, very easy mathematics, but you have to pay attention. One of my friends or one of my co-authors' friends got into this earlier, and he made quite a fortune out of it because I assume most people don't understand even this is really simple mathematics. Right? So now let's move on to the next section. Okay, I already spent 20 minutes. I guess that's okay, right? Because I really want all of you to take back something of this talk, right? At least that gives you a quick overview of the overall types of contracts and complexity. Okay, so hedging is to us, to people in math finance, that's a question we don't even need to answer, right? Hedging is just obvious, right? But people in finance, they may ask us why we consider hedging is because Bitcoin is likely the most volatile asset, right? So here I have some examples, some numbers to show you This is, you may lose 20% in half an hour. Right? You attend this talk, you lose 20%. It's possible, right? So it's really a crazy world, in the when you trade cryptocurrencies, right? Remember, those unregulated exchanges never stop. How many hours do you sleep? Right? Think of that. It's crazy, right? You can't even go to sleep because at worst things can really happen, right? And you don't have time to react. Okay, so we really should study hedging, right? Because one particular reason I want to mention is people so-called the on-chain, off-chain, right? I mean, the actual Bitcoin transactions happen on-chain, right? Only when it is recorded, verified, it's an actual transaction. But sometimes, oftentimes, exchanges need to carry out their own book, right? Off-chain book, right? So when you buy Bitcoin, let's say from CoinDesk, the transaction is almost instantaneous, right? That's off-chain, right? You can't do instantaneous transaction on Bitcoin on-chain. It takes time to verify. And if your transaction is small, people even don't bother to put your order in priority, right? You need to pay transaction fees to bump up so that people are willing to include your request into their block, to be verified, right? So those exchanges do carry risk, by being a market maker, right? Sometimes the price really move quickly. They could lose money, right? By being market maker and not being able to get the transaction really done on chain, right? So hedging is very important. One particular thing I want to mention is the so-called auto-liquidation. This is another feature likely unique to Bitcoin futures, because when we teach futures, right, we calculate those examples. We say, when you are going to receive a margin call, right? So when your account is below the maintenance level, exchanges will call you, right? That's why they call it the margin calls. Warning: there are no margin calls on Bitcoin futures, especially on those unregulated. They don't call you. If your margin account is below, they liquidate your position. It is that simple. They don't even bother to ask you to add collateral. If your margin is below, they close yours. They force your position to be closed. It is very, very complicated. It's more complicated than just I mentioned. For this reason, in our work, we assume your entire position is liquidated. So in fact, they don't do that. They do what they call the partial liquidation, right? So let's say you still have something in your margin account, right? And they do a quick math to see, for the current margin you have, how many contracts can you hold, right? So let's say currently you have 100 positions, right? Maybe your margin is not big enough to support 100 positions. Maybe it's only big enough to support 90. So they will first liquidate 10. And if the price still moves against you, they will continue to liquidate. It is a very complex system. I don't even know how they do it. Those exchanges, they don't specify how this mechanism works. They tell in vague words that they will do a such thing. That's what I already mentioned. When your margin is below, they will liquidate you part by part. But I don't know exactly how they do that. Okay, so but here we do have some data, which we downloaded online to show you liquidations are enormous, which is not surprising because remember your 100 times leverage or 125 times leverage, you only have, let's say you only have 1% in your margin account to open the futures position, right? And we know Bitcoin price moves, easily 3-5% in 10-15 minutes. Right? You open it, you use your bathroom, your position is gone. It happens so often. That's why the liquidation is so high. Again, the y-axis is in billion US dollars. So this is the weekly liquidation amount. It's in can be in several billion dollars. Sometimes on a single day, it could be more than $1 billion US. in some weird days, like May 19th. It's something everybody should remember. I will briefly tell you why. So here is we did some math to show you, if you really don't care, if you just open a position. So let's say you open a very high leveraged position. In 8 hours, you have 95% chance that your position are closed. Not by you, by the exchange. Okay, forced to be closed. It is very, very high. Right? I mean, even you take a very low leverage, 5 times is considered a very, very low leverage in the crypto world. Right? You still have, let's say you trade 1 week, 5 days, not 1 week, 6%, right? Still noticeable. So liquidation probabilities are very, very high when you trade Bitcoin futures because of the leverage, right? So if you are a speculator, that may not be a huge issue because closed, then it's closed, right? It's just like when you buy a stock, if you lose money, you hold it, right? But for hedges, it's a big issue, right? Because your goal is hedging, right? It's to manage risk, right? Your goal is not to make profits out of it, right? If you are liquidated, you end up with a naked spot position. Your hedging purpose fails. If you don't even have futures, right? You are left with whatever you have in your Bitcoin spot, right? You fail the purpose to hedge. So that's why we argue that in such a hedging paper, it is crucial to include liquidation, right? We assume hedges are liquidation averse. Okay, I hope I have convinced you that it is important. This is another unique thing. I already mentioned, right? Those online exchanges, they will liquidate traders' positions, but they don't actually use the market price. So the liquidation is not based on the market price, again, which is something different, right? When you calculate the margin cost for regular futures, you do use a market price, right? There's only one price, right? In this, they use the so-called fair price marking. So they use a price which is different from the market price to determine whether your position should be liquidated, okay? But once they decide your position should be liquidated, they use the market price. So basically, this fair pricing or fair price marking is introduced, well, at least that they are supposed to reduce liquidation probability. As I already showed you from the previous 2 slides, right? They are high. The amount of liquidation is simply too high. They try to introduce this to reduce, okay? Their argument is this usually will be smoothed. They smooth the price, okay? So let's say if the price drops too quickly, this will be higher than the market price so that fewer positions will be liquidated. For the same reason, if the price goes too high, those the fair market price will be lower so that short positions can somehow hold for a little longer. But our key message is that the overall impact is marginal, is nearly negligible. It only matters when there are extreme market conditions, and even that is not too obvious. For instance, I consider a very, very extreme example. In a very, very extreme period, okay? They are able to reduce probability, liquidation probability by about 1.5%. That's the extreme case. In our study, pretty much zero. We can't even tell. So we do not do this, but I want to mention because it's unlikely that you will know this from any academic paper. We have never seen anybody doing Bitcoin, even mentioning this. So this is a unique system. So we consider perpetuals in this study not standard simply because of liquidity, okay? Standard, they have very, very low liquidity, so we don't consider it. And also, I have another paper which shows if you use CME contracts, the hedging effectiveness is okay, but far from good, okay? Those perpetuals or those unregulated future contracts are much, much better, right? Because of liquidity, right? When you hedge, you do want the future price to be highly correlated, right? Because we know correlation plays a role in hedging, right? The higher, the better, right? So there are many other advantages. I already mentioned some of them. For instance, you can match exactly the horizon, the hedging horizon you would like to hedge or you would like to choose, right? And no need to consider rolling because they never expire. And also you don't need to consider what contracts you want to select because on any given exchange, there's only one perpetual, right? One USD perpetual or one USDT perpetual. But there are many, many actively traded standard futures, with expiries you need to determine. So we ignore some issues with that. So here's a quick summary before I go to the mathematical part. So we argue that two things are really important. One is margin constraint. The second one is liquidation aversion. They are correlated, they are twins, right? Because they are huge liquidations, and liquidations are terrible to hedges. So hedges should be averse to liquidation, right? And liquidation happens because any trader can only come up with limited collateral, right? I mean, nobody has unlimited financing power to meet the margin requirement, right? So that's why margin constraint is also important, right? Because of the margin constraint, they are liquidations, right? And because liquidations are bad to hedges, we should take it into specific account when we study hedging, right? So that's why we will consider those two features in our study. I mentioned the May 19 event I called Unprecedented. If you are interested, please read my co-author Carol's blog. She wrote many interesting articles on the general cryptocurrency. This is a special one. This is special because the price dropped about 20% in 30 minutes. And the Binance, what I call is unplugged the cable. They don't allow you to trade. It's probably not too surprising because Robinhood did the same thing, right? They don't allow people to buy those. What are those stocks? I forgot the name. The GameStop, right? What they do is just simply unplug the cable, so there are no trading. And right before, for maybe 20-30 minutes, long future traders can't even add collateral. They can only sit there and watch their position being liquidated at nearly the worst price. They can do absolutely nothing because they can't add collateral. If you can't add collateral to your account, your position will be liquidated. And this price may not be something you like, right? So that's terrible. And that's not the end of it, right? Because right now it's the perfect time for short traders to close their position, to pocket the profits, right? Because the price just went down 20%. So short traders make enormous money, but they unplug the cable for how long? For nearly 2 hours. So the short traders, even though on paper they are making tons of money, they can't close their position to pocket the profit. So the profit is only on your screen. You see on your screen you are making millions of dollars, but you can't really cash in. They unplug the cable for nearly 2 hours. And by the time when the system is back, the price is almost back. So it's the pitfall, when you trade with those unregulated, exchanges, right? Because they are the king. If they unplug the cable, there's nothing else, there's nothing you can do, right? They are headquartered in, I don't know, Seychelles or Cayman Islands. There are no laws, on them. So there's nothing you can do. This actually motivates many discussions in industry. I am 100% sure we can come up with many, many questions. I have many questions. I just don't know how to properly put it in a model to study, because this is unprecedented event. Right? We learned so much from it, from the financing. I mean, I'm sure this event will go to the business case simply because it's one of the unique cases we have, right? I mean, exchanges unplug the cable. I mean, they do claim this is due to technical errors. Okay, but you can really read Carol's blog and get more information. Literature I can skip because there are no literature. Okay, the only papers are our own papers. So it doesn't hurt to skip. I mean, so now let me show you what we actually do, from the mathematical side. So some setup. So this is a discrete model. It never hurts to study a discrete model in empirical finance. After all, what you have is data, data discrete. So S and F are both quoted in USD, right? As I mentioned, although we have different denomination units, but the price are always quoted in US dollars. So if you study inverse, you need to convert them like this. So if you study inverse, you need 1 divided by the future price, right? So here I assume the notional value is $1 USD for the inverse contract. Okay, it can be different than 1, such as can be 100. So here I introduce this to simply account for the P&L. Again, it would be the enter minus the exit. Okay, so we consider a hedger who owns 1 Bitcoin, so unitized, and the position she's going to short is our control. So she will short theta inverse perpetual. So actually we consider 2 types. Does not have to be inverse. It can be inverse. It can be USDT direct. So direct are standard contracts with USDT replacing USD. So we consider 2 types of perpetuals. Okay, so that means it will be slightly different. So here it is the case when I consider inverse. Like I already mentioned, in the first version, we only consider inverse. So the direct is actually easier to get the P&L because it's direct. So the P&L is simply delta F, right? So here you will notice that I times by the spot price because here is in BTC. For inverse contracts, your P&L is denominated in Bitcoin, right? And your changes in spot obviously is in USD, right? The price changes is always in US dollars. So we convert this to USD by multiplying the spot price at the time when you close, okay? So what would be the objectives to optimize? So this is standard in hedging, right? You are trying to minimize the variance, right? That's the so-called minimum variance strategy, right? So that's the also the textbook treatment, right? In Young Health's book, right? You try to minimize the variance, so you get this low, right? Sigma S divided by sigma F, right? So here our portfolio is slightly more complicated, right? You need both futures and the spot markets to convert everything in USD. The second one is the innovative part. We already argued that I shouldn't say default probability, liquidation probability is enormous and it's important. We should care about it. So we define liquidation probability as this. So let me briefly mention what it is. Okay, so theta is simply the position, right? And so this is the P&L for long traders. Okay, here our hedger shorts the position. So the positive part of it. So that's why I take the maximum. So the maximum of this is the loss to our hedger. So when the loss is greater than some threshold, we call it liquidation event. So this threshold is exactly the hedger's margin constraint. Okay, so let's say the hedger only has 20% margin constraint. Then if the price movements is beyond 20% against her positions will be liquidated, right? I mean, it's simple to understand here, right? Because I somehow take a simplified setup. I assume once this happens, all her positions will be liquidated, okay? So now we aggregate them together. We have 2 objectives, okay? We want to minimize both, right? So a natural way is to add them together. And here we introduced a parameter which we call liquidation aversion, okay, because they are on different scale, right? This hand side is the probability. This is the variance of your hedged portfolio. So to have them, on the same scale, we times by aggregating factor, which we call it the liquidation aversion, right? So two limit case is when your m goes to infinity or your gamma goes to 0. If you never care about your margin, this is just a 0, right? Or when you have enough money, right? Your liquidation will never happen. Then this probability is 0, right? But of course, that's not the case in reality. Here is a mathematical result. It's simple. It's just the first order condition to get the candidate strategy, and use the second order to verify. So there's no need to pay attention to what this is. So it looks in this form. Okay. What I should mention is there are some parameters later on we need to estimate. So it's alpha, beta, gamma. Okay. This comes from this part because the variance is easy to handle, right? We can easily handle variance. The difficult part is the liquidation probability. Right? We try to include that in our objective and to minimize. So to handle the liquidation probability, we apply the so-called EVT, extreme value theorem. Okay, we approximate it using this. Then taking derivative is easier, right? Otherwise, it's probability, right? We don't even know how to handle. So this is rather standard for many people in actuarial science. They do this quite a lot, do the extreme value theorem. And in futures trading, there are also papers, applying extreme value theorems to study the tails. Okay, so obviously here, what we call is a right tail. A right tail is the profit to long traders, but losses to our hedges. Okay, so we have three important parameters, and tau is the most important one, because alpha and beta you can always scale. Okay, once you have data, you can minus by something and divide by something that will change alpha and beta. Okay, but tau is stable. Okay, and tau, the sign of tau tells you roughly the distribution of your EVT. So when tau is greater than 0, it's Fachet. So it has the heaviest right tail, which is the red line. Okay, 0 is Gumbel, less than 0 is Weber. So for us, it's always greater than 0. So we have some dynamic graph to show when we estimate by a moving window what this tau would look like. It's actually quite stable. Okay. Some people they comment that EVT only holds when those returns are IID. Actually, we don't think so. We read a few papers, and some of them even specifically mention EVT. At least this approximation also works reasonably well when the data are not IID. In particular, that is the case here. So to convince people that this approximation is actually good, even works for Bitcoin data, we do this. So remember, in here, this is for inverse, right? For inverse futures, the return. We actually started for spot. So this is for spot. The first row is for spot. The second row is for the direct futures. The last one is for inverse. So in all cases, this is 1 minute, 15 minutes, and 30 minutes. The accuracy is outstanding. Right? I mean, it's pretty much they coincide. So we argue that we can really apply because the accuracy is nearly 99%. So it actually works even when the data are not IID. Okay. So next, let me mention the empirical analysis. Okay, I think time should be rather okay. We considered the 3 spots before, but right now we only leave the most important one, the Coinbase. This is likely the most trusted, or one of the most trusted. We consider 2 types of perpetuals, right? USD inverse and USDT direct. Those 3, when we wrote the paper, they are the 3 top exchanges. with the highest trading volumes. I should remark that those rankings always change, right? So they may change. You may argue why you have this, which is not the top 3, right? So here are the top 3 ones, okay? The data sample. So first, let me show you some sensitivity analysis. Those are obtained by setting the parameters to those numbers. So those are not calibrated using data. I just want to show you the impact of several important parameters, right? For instance, here, margin and liquidation aversion, we argue are important. That's because if your margin constraint increases or you have more money, your strategy is, by the way, it is always about the optimal hedging strategy, okay? So when you have more money, you tend to hold more, okay? Because in one of the cases, I think for those numbers, 1 should be the naive hedge, okay? So even when you have enough money, it is not exactly 1, but you can see it increases, right? And here, when you are more averse to liquidation, you will hold less in hedging, right? Again, that's our intuition, right? The other 2 are also important, but I'm going to skip them. Here are the graphs for the optimal hedging position. Okay, first they are rather stable, right? I mean, of course, if you look at the scale in those graphs, they may change. Of course, they may change because this is the dynamic hedging, right? We do the moving window, so it's obviously not a constant. But overall, it's rather stable. Okay, as long as you ignore this part. So this green line is derivative. So technically, it's not top 3. We include this because Carol and Jun are doing another work on Bitcoin options. Oh, by the way, Bitcoin already has options. Debt is a major player for Bitcoin options, and sometimes if an exchange is trading is a trading platform for options, you would argue that it makes natural sense for them to hedge. So that's why we consider it. But it's really if you ignore this part, the rest are similar, meaning there are no visible differences, among different exchanges, although there are plenty. Okay. The hedge effectiveness here is some graph. So this is what I want to pay some attention. So the green ones are unhedged. So as you can see, this is not that much because we picked one special example. In some of the examples, you can really see the difference. So for the unhedged, the green ones, they really spread out. But for the hedged ones, it's more centered. Okay, so there are less variations. But in finance, a standard metric to measure the effectiveness of hedging is so-called HEDGE. It is the percentage of reduction in variance. So the bottom is when you don't hedge. So when you take theta to be 0, you have a naked position. Okay. So theta here is when you hedge. So you do the ratio of their variance, and 1 minus it would be the how much you are able to reduce the variance in percentage. So here are the selected numbers. Remember, I have 4 inverse, 3 direct. Okay, so 4 means 3 plus 1. The 1 is derivative. Okay, so I have 7 future contracts. So it's a very, very long table. I only show you 1 from inverse, 1 from direct. So what I can say is, so obviously, as horizon increases, the hedge effectiveness will decrease. Okay, so that's our intuition. Something good is, if you look at those, I just circled. So assume your margin constraint is 50%. Remember, here we assume the trader has 1 Bitcoin. Okay, so it's almost half. Okay, with that in mind, you can see that it's very, very good, right? Most of the numbers are close to 100%. you can pretty much eliminate the risk, right? So what is the takeaway message from here is when you have relatively sufficient amount for your collateral, or if you have prepared enough for your margin account, you can really manage your risk. Okay, and of course, if you only have little, if you only have 10%, the effectiveness varies a lot by the horizon. So we consider 8 hours, 1 day, and 5 days. So if you have 5 days, the results are not that good because you have so little money prepared or reserved for hedging, right? So of course, you may argue, I don't want 99%. Then what you can do is the reverse engineering, because you can always find a suitable level. By the way, that could be an interesting question as well. You know, for instance, you already have an ideal range. So for instance, you want to reduce your variance by, let's say, 80%. What would be the collateral level I should prepare? You can do reverse engineering to figure out this, right? It could be an important question for hedgers, right? But the big message is that by controlling those features, you can still manage the risk, right? This is something I want to highlight. Remember those, I should change the title, is the liquidation probability, right? Remember those liquidation probabilities are really high. However, in all those figures, I mean, the numbers are in percentage, right? They are not crazy at all, right? I mean, even for 5 days, sometimes you see 2%. 2% is very reasonable, right? Remember the table I showed you earlier on? It can be as high as 60, 70, or even 90 some percentage, right? So now our framework indeed leads to a reasonable solution. That is, the liquidation probabilities can really be controlled, right, to a tiny level. The last one I mentioned is the so-called leverage, right? Remember, it can go as high as 100 or 120 times, 25 times leverage. But if you follow the optimal strategy derived in our work, the implied leverage is actually not crazy, right? Most of the times is even less than 5 times. 5 times is considered very low leverage. So by doing this, the hedges will actually limit their leverage, okay? And that's because they care about liquidation. If you take a position with high leverage, your liquidation probabilities will be very high, okay? I'm going to stop here, the conclusions. I mean, I already mentioned the most part because they come from the empirical part, okay? So I'm going to stop here, and here are some references. If you are interested in the paper, they are available in many places like Archive or SSRN. You can read the full paper for much more results. I skipped many results here today. Okay, thank you, and feel free to ask questions, I guess.
Thank you so much. Okay, so is there any question for Bin?